Hi everyone, good morning. Welcome back to the channel. Today we will be continuing with the weighted average cost of capital. So previously we have discussed about the formula of weighted average cost of capital and the components. And to summarize it up, this pictorial diagram, let's study this pictorial diagram. So weighted average cost of capital is actually divided into equity and debt, and it represents the overall cost of financing for from all the capital providers. Equity providers, the calculation is done using weighted the CAPM, capital asset pricing model. The cost of equity is actually the risk premium is actually the cost of equity is actually calculated using uh, capital asset pricing model, CAPM, which we have previously discussed. And the cost of debt is calculated using the averaging of the debt which the company has raised previously. So this is CAPM, capital asset pricing model. And for debt, we average the 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 cost of debt raised previously by the company. We have discussed about the formula. The formula contains the percentage of equity in the capital structure, percentage of debt in the capital structure, and then we multiply the percentage of equity by the cost of equity. Then we multiply the percentage of debt in the capital structure by the cost of debt. And there is a tax shield also involved when we talk about debt. And because of the tax shield, basically the cost of debt is usually lesser than the cost of equity. Okay, so I hope this much is clear. If you have attended the previous video or if you have missed the previous video, kindly uh, watch. I will recommend you to watch the previous video so that you can get a better picture of what we are discussing right now. So this is a continuation episode of the previous topic. Okay, so let's start with what we left discussing. So the last topic which we were discussing was the use of weighted average cost of capital in business and finance. When we look at uh, the uses of weighted average cost of capital, so capital budgeting comes into mind. So it's used in capital budgeting. WACC is weighted average cost of capital is used as the hurdle rate for evaluating project. Hurdle rate basically here it means that a specific rate above which, so this is expected returns. If our expected return of the project is above our hurdle rate, this much weighted average cost of capital, so we are going to accept the project. And if the expected return on the project is less than the weighted average cost of capital, we are going to reject the project. So here the hurdle rate means the hurdle rate is trying to point you toward this direction. Project must exceed weighted average cost of capital to be acceptable. And business valuations, weighted average cost of capital used in DCF valuation, which here weighted average, the plugins of the interest rate, the plugins of the discounting rates is calculated using weighted average cost of capital in valuations. When the weighted average cost of capital is low, it increases the valuation because we are discounting it Back to the future, when we are discounting it back to the future, so we are discounting by a lesser rate. This means we actually have a greater denominator, or sorry, a greater numerator actually. And a higher weighted average cost of capital decreases the valuation because of the risk involved. So weighted average cost, or any rate or any kind of rate is actually associated with, it's directly proportional to risk. So if rate increases, so it implies that because of high risk. And when rate decreases, this actually sends a sentiment that the risk is low. Or for, if we're talking about the risk-free rate, let's assume for government securities, why the risk-free rate is zero, government securities, why the risk-free rate for the rate is zero, because government actually is a more powerful entity, figuratively, and government can never go bankrupt. And even if there are if there is a situation where the government defaults, so the government can always print money. But the long-term effects of printing money, quantitative easing, which is known as AKA, so the long-term effects are way too much worse than the short-term effects. And we will discuss about these topics, these concepts when we will discuss about economics, or when we will start talking about economics in finance. Uh, then we will be able to make a better sense out of it. So let's stay on the topic. So uses of weighted average cost of capital in, so one use is also optimal capital structure analysis. So optimal capital structure analysis means, companies actually need to balance the debt and equity to minimize the weighted average cost of capital, which actually increases the firm's value. So what should be the portion of debt and what should be the portion of equity in a capital structure, so that uh, you can create a firm's value, you can increase the firm's value. The best fit, this is what they are talking about. The optimal capital structure means the best fit, best fit. And to this, to understand this best fit thing, uh, we actually need to look at the peer companies. Because if you are comparing something, you cannot compare something in isolation. So you need to compare across the similar entities, which is also known as peer companies. Acquisition and merger analysis. Investment bankers rely on weighted average cost of capital to evaluate acquisition targets. And the weighted average cost of capital is used there in acquisitions and merger and analysis. How much money during merger and analysis, during merger and acquisitions. So what they are doing is, they are actually raising their own capital. So they are raising capital. If they are raising capital, it will be LBO. So using LBO, they are merging. Okay, they are doing an acquisition using using debt. So lot of debt is involved. So when they are doing this, the question will be, how quickly can they turn around the company and sell it back? So merger and acquisitions. If you're merging with a company or acquiring a company, so basically merger and acquisitions are done when a company cannot grow organically anymore. So what they start to do is they start to acquire uh, competitive companies, or just to acquire the another company's market share, because Organically, now there is nothing new that they can do. So they start with acquisitions and mergers, but they cannot do it just like that. They actually, a lot of calculation is involved, and weighted average cost of capital actually is the discounting rate which is used here. Okay, so let's talk about performance analysis, performance metric. Weighted average cost of capital also works as a performance metric, where and how to calculate the economic value added of a project. So if the economic value of the project is greater than zero, this means the project has generated premium returns. So if we have invested X amount of money and our weighted average cost of capital was a certain percentage, if that amount is greater than the NOPAT, net operating income, so this is going to, if it's greater than zero, the company is generating a premium return. So this is also used in a performance metric. Okay, let's talk about the limitations and the challenges of weighted average cost of capital. So WACC is useful but not perfect. The first point here is that it's difficult, the difficulty of estimating inputs because beta keeps on changing over time, and cost of equity, cost of beta is used to calculate the cost of equity, return of equity, sorry, R represents the cost of equity. Market risk premium is debatable, or it's very much debatable whether how much market premium should be. Risk-free rates also fluctuate, and small inputs, in small changes in the input can also change or alter the weighted average cost of capital considerably. So this is one thing, which is this is a limitation of weighted average cost of capital. And the second limitation, the another limitation is that we assume the constant capital structure, that we are assuming that the capital structure is not going to change for the time period, for that time period for which we have actually used that in the forecasting time, in the forecasting scenarios. So when companies restructure or grow rapidly, their assumptions doesn't hold. So the assumptions actually changes when the capital structure changes. But we need to actually keep on updating our valuation. So this is also a limitation of weighted average cost of capital. So WACC assumes stability in debt equity mix, which may not hold during the period of rapid growth, restructuring, merger and acquisitions, and market volatility. So this is also a limitation or a challenge which comes along with weighted average cost of capital. Uh, then it's not suitable for all projects also. So WACC is not suitable for all projects. Using one weighted average cost of capital for all divisions may lead to overestimation in the risky divisions and underestimation in the safe divisions. Safe divisions. Uh, each project ideally needs to have its own risk adjusted rate. So because we have calculated weighted average cost of capital, we are applying it everywhere. This doesn't also make sense. So this is also a limitation of weighted average cost of capital, and uh, calculating the WACC or the expected return or the return, the internal return for all the projects is also very time consuming. And yes, but in practice, it's done differently. Theoretically, it's not suitable to every project. So everywhere we cannot calculate the hurdle or the benchmark using the weighted average cost of capital. Also, it's hard for private firms because private firms actually lack market prices, betas, and bond yields. So estimating the weighted average cost of capital becomes subjective here for private firms. And also I mean, one more thing which is the limitation of weighted average cost of capital is it's backward looking, not forward looking. Why it's backward looking? Because weighted average cost of capital is often based on historical data and may not reflect the future risk, challenges, the changing market conditions, and new financing opportunities. So it's backward looking. And historical inputs may not reflect the future condition also. So this is also one limitation which comes with weighted average cost of capital. So yes, there are limitations to weighted average cost of capital, and we still use the weighted average cost of capital, but there is a different version of weighted average cost of capital we use when we are calculating, when we are doing things in theory and when we are doing things in practice. So that we are going to discuss later on when we will be doing practical valuations. Uh, all right. So the next point, the next topic here is uh, when weighted average cost of capital should be used and should not be used. So the appropriate use cases for weighted average cost of capital are when you're valuing an entire company. That's one thing. Uh, when you are actually evaluating standard projects which are similar to the ongoing operations, so they should be similar to the ongoing operations only, then you can use weighted average cost of capital. When you are capital budgeting in stable firms, so the firm should be stable also. But or the portfolio level investment decisions when you are making these, so weighted average cost of capital does make sense or is appropriate when you're using it in these kind of scenarios. But you should stop or you should not be using weighted average cost of capital when the risk, when there is high risk or low risk projects outside the core business. So why outside the core businesses? Because you actually have the understanding of your business, not everybody else's business. So understand this thing. What does core business means? Just for the sake of low risk or high risk for greater return, don't invest or don't get into those things which you do not understand. So you need to di- get into or take projects from your core business expertise, not from other business sectors. So you should avoid using weighted average cost of capital in those scenarios. New venture or experimental divisions, don't use weighted average cost of capital in those new ventures or experimental divisions because the risk is going to be high and weighted average cost of capital doesn't make sense using, I mean, applying the weighted average cost of capital doesn't make sense in new ventures or experimental divisions. Firms with unstable capital structure should also be not using weighted average cost of capital because the foundation of weighted average cost of capital is about the foundation is capital structure. But once the capital structure changes, the weighted average cost of capital also changes. So that's why it's advisable not to use or to avoid using weighted average cost of capital when the capital structure is not stable. Companies heavily financed by hybrid or complex structures. So this is important. What does complex or hybrid or complex financing instruments means? So these are basically convertible securities, and that's why investors, when you are doing a proper valuation of a company, you will be looking into the those securities also which have a tendency to get converted into equity in future. So you will be looking at the the overall capital structure of the company. Those companies which do not have convertible debt in their capital structure, those are known as uh, simple capital structure. But in a complex capital structure, convertible securities and other kind of securities which are little tricky comes into place. So which can tweak the company's capital structure. So that those comes into play. And in such cases, project specific discount rates. can be used, or adjusted present value APV methods are better. I hope this much was clear. And uh, okay, so let's understand one thing. uh, how weighted average cost of capital and debt are related. So increasing or decreasing debt actually it actually affects the company's weighted average cost of capital. And although changes in capital structure weights, tax benefits and risk level, often they actually once you are changing these things, so it will actually make a U-shaped curve where moderate debt actually lowers weighted average cost of capital, but excessive debt actually increases the weighted average cost of capital. Understand this thing. This much debt you are using, it's decreasing the weighted average cost of capital. But after this point, the weighted average cost of capital is actually increasing with the increase in debt. So adding debt initially reduces the weighted average cost of capital because debt is cheaper than equity due to its lower cost and in the tax shield from deductible interest payments, which actually lowers the after-tax cost of debt. So RD into 1 minus tax rate. And higher that proportion weights more for this low cost financing into the weighted average cost of formula. So debt upon equity plus debt. So however, beyond this optimal point, mm, raising financial risk increases both the cost of debt and the cost of equity, pushing the weighted average cost of capital upwards. And reducing debt raises weighted average cost of capital initially by shifting the weights towards higher cost of equity and eliminating some tax shield benefits and increasing the risk of equity proportion. Uh, so the lower financial risk potentially decreasing, uh, this can be done by decreasing the return on equity and our return of debt slightly over time, but the loss of the cheap tax advantage, the debt usually dominates and making overall financing more expensive. And firms with high existing debt benefits and deleveraging to firms actually do these things. So they actually uh, firms with high existing debt and from deleveraging to avoid distress cost, but stable firms may use or see WACC to rise without proportional risk reduction. So just remember this thing that after a certain point of time, with increasing debt, the cost of capital also increases, weighted average cost of capital. Okay, so we have discussed almost everything about weighted average cost of capital. So let's test our concepts by doing some question and answers. So where is it? My mouse was not working. Okay, so let's test our concept because the best way to test our concept is by applying it. So there is a question. If a firm has risk-free debt and uses capital asset pricing model to estimate the cost of equity, and if the corporate taxes increases while the capital structure stays constant, what happens to the weighted average cost of capital? Now understand this thing. So the question is asking is that debt becomes the tax shield. The firm has risk-free debt and uses capital asset pricing model, and the cost of equity is used calculated using the the weighted average cost of capital, this debt is risk free. So even though it's risk free, there is going to be a tax shield. Yes, then there is going to be a cost of equity. If corporate taxes increases, if taxes increases, while the capital structure remains constant, let's assume it's 50-50%, what will happen to the weighted average cost of capital? Now understand this thing. The corporate tax rate is increasing. This means initially, if it's for 25% and now it's 35%. So initially, this portion, 50% portion was to the 50% portion was uh, only 75% of the 50%. They were only paying, only calculating using the 75% of the 50%. And now they are only using 65% only because of 10% increase in the tax rate. So this means that the weighted average cost of capital is actually going to decrease now. I hope this was clear. Yes, it's a little confusing, but yes, this is actually how in practice you do these kind of things. Okay, let's move to question number two. Which of the following must always be based on market values and not on the book values when computed weighted average cost of capital? Yeah, and we talked about the capital structure weights. So the weights which we are using should be on the market value, not on the book values. Question number three is about the project has higher risk than the firm's average project, and using weighted average cost of capital, evaluate this project will or will not be most likely be what. So understand this thing. The project has higher risk than the firm's average project. So I am saying that it's above benchmark. So whatsoever projects we have, firm's average projects, this project has actually higher risk than the firm's average project. And using the firm's weighted average cost of capital to evaluate this project will most likely we will be doing in this kind of situation, we will be overvaluing the project. Why? Because weighted average cost of capital will this will actually why? Because the discount rate would be too low for the weighted average cost of capital. And if it's lying somewhere here, the discount rate would be low and we will be overvaluing the project in these kind of situations, which would be wrong. Okay, so question number four is company issues perpetual debt with coupon rate of 7%, perpetual debt with coupon rate of 7%, but its current yield to maturity is 5% and tax rate is 30%. What is the current cost of debt for WACC? So in these kind of situations, the market yield to maturity is used to calculate the weighted average cost of capital, not the coupon rate. Coupon rate means, let's assume a perpetual debt or $100 debt is $100 bond is issued by the company. Coupon rate means every quarter you will be receiving a 7% coupon rate. Perpetual yield to maturity means, so this $100 bond, whether it was issued to you at premium or at discount, this is the face value. And at the end of the time, you will be receiving only $100, the face value of the project. The current yield to maturity is 5%. So this is what we are going to use when we are calculating the cost of debt. So we will Not using 7% here, not this, but yes, 5% into the tax shield, because with debt, shield always comes into play. All right, so question number five is, if the firm increases leverage, but the cost of equity rises exactly to offset the tax advantage debt, the firm's weighted average cost of capital under Modigliani Miller with taxes will be. Okay, so here in this question, the cost of equity rises exactly to offset the tax advantage debt. It's the scenario, and we have not discussed about Modigliani Miller theory. So let me just give you a quick a quick solution for this. So understand this thing. Debt actually works, or debt actually helps us to lower the weighted average cost of capital, even if the cost of equity rises. And here in the question, if the cost of equity rises exactly to offset the tax advantage debt, still the cost of the weighted average cost of capital is going to decrease, because the debt actually uses the tax shield, and the tax shield actually usually lowers the weighted average cost of capital even if the cost of equity is rising. So with that, let's conclude today's session. And these questions, these actually were tricky questions. So I hope you have understood the weighted average cost of capital as a concept and why it's important to understand these things. And we have discussed about why in CFOs, the programs, CFO programs or financial professional programs, they actually teach cost of capital and these corporate finance topics, because see, understand this thing, even after 20 years of experience, that's the eligibility to enroll into these kind of programs. 20 years, 15 years, more than 15 years in a senior position, then only you will be able to enroll yourself for these exams. But understand this thing, these are the basic elements of corporate finance, and you need to understand these concepts crystal and clear so that you can apply them later on in your life. When you're working at a entry level, the work profile or job description is different. But when you are working in a at a senior position level, or a senior, I mean, you're running your own business. So basically, what happens is, there is just one job, from where you can get the money, from where to raise, and to where to invest. This is basically the decision making, what the top level management or the top level executives, the C-suite executives, C-suite, CEO, CFO, actually, or majorly CFO, the Chief Financial Officer, they actually do, from where to raise the capital and to where to invest the capital. The inflow, they control the inflow and the outflow of the capital. So that's why weighted average cost of capital into comes into play. And all right, so that's enough for today, I think. And let's move in. Let's meet in next session. I hope you have learned of something of value today. And I will be open to any suggestions or any questions. You can post your questions in the comment section, or you can write to me on my mailer ID. I'll share my mailing details. All right. Thank you, everyone. Thank you for attending the session. My name is Deepak Mist.